We're now going to move on to the second key heading in IAS 7 called investing activities. Now, the main focus we're going to see in AC 220 for investing activities is the acquisition and disposal of non-current assets. Now, realistically, what we're going to look at here is the companies acquiring property, plant and equipment, companies disposing of property, plant and equipment. The other things that you might see in here are companies, for example, acquiring or selling investments in other companies. These things called subsidiaries. You're not going to see that in AC 220. That'll be more for final year and master's level where you deal with group accounting and consolidated accounting. But mainly, as you'll see from the template that we've given you, in terms of investing activities, it's either going to be the purchase of property, plant and equipment, which is a cash outflow, the disposal of property, plant and equipment, which would be a cash inflow. If you purchase or dispose of investments, so remember, these will be investments that wouldn't qualify as a cash equivalent. So if you invested money in an account for maybe a 6-month maturity, or you put money into a portfolio of shares, that will be the acquisition or disposal of financial investments. Generally in AC 220, we will put interest received and dividend received in here as well. There is some options in terms of where you want to put that. You can put it into operating, you can put it into financing, but just to be consistent in AC 220, we will put interest received and dividend received in there as well. But there is flexibility shown to those items in case you see other solutions that do differently. So we need to figure out then, well, what are the kinds of adjustments that we're looking for in calculating these cash flows? So cash payments or cash receipts from dealing with non-current assets. We're not going to see these really when we're acquiring equity or debt in other entities. That's called group accounting, where one company buys an interest in another company and you have a group of accounts. That's going to be more for final year and for master's level. So don't worry too much about that. It's the line items that we have in the template on loop are the main ones we're concerned about. But similar to other questions, this is all about solving a puzzle. So for example here, let's look at property, plant and equipment. And this could be the type of one that you're given in an exam where you're told, here's the statement of financial position for the company. So you're told non-current assets, the net book value has gone from 1.2 million up to 1.3 million. Now you might say, well, surely that means we've an increase of about 100,000. But that misses that there's a lot more going on in the question you need to consider yourself with. So for example, we know during the year depreciation was charged at 228. We know there was a profit on disposal, and we know that the asset was disposed of originally cost 120,000. And what they're asking you is, what are the relevant figures to be included in the investing activities in relation to the purchase and disposal of property, plant and equipment? Now, from an operating perspective, this depreciation and profit and disposal, they will be two separate adjustments. So when you're doing your indirect method, we're not doing it now, but if you were, as up here, you would have to take off the profit and disposal and add back depreciation. So they can impact different areas on the statement of cash flows. However, what we're interested in now is, well, how much do we get for the sale of the equipment? And how much do we buy in new equipment? So to figure out that, let's have a look. So we're told here the asset disposed of had originally cost 120,000. The profit on disposal was 24, but we actually don't know what we sold it for. So we're trying to solve a puzzle. So see how tricky it can be here. So we'll bring this in, we'll make it a bit smaller. We're going back to our T accounts again. So the first approach here is to figure out, in this case, well, how are we going to figure out how much we sold it for? So we need to know the net book value of the asset at disposal. If we know what the net book value of the asset at disposal is, that means we'll figure out what the disposal proceeds were, because we know it was a profit on disposal. How we can figure that out is by using the accumulated depreciation line. Now that is tricky, but these are things we're trying to show you now that you can apply in other questions. So if we take accumulated depreciation, right, let's think about what we're given, and let's think about what the plug figures might be. The opening balance was 695 on accumulated depreciation. The closing balance was 812. So what moves accumulated depreciation during the year? There's only two things that move accumulated depreciation. You always assume the figures that you're given are correct. You're given a correct and final statement of financial position that has already accounted for the disposal. So we know 695,812. We know there was depreciation during the year of 228. That would have increased accumulated depreciation. So see the way you're using the information to solve a puzzle. So if we had 695 and 228, the closing balance on accumulated depreciation should have been 923. But actually, the closing balance is only 812. The only thing that can reduce accumulated depreciation, now a revaluation might, but we're not told about anything, is the disposal. So that means the accumulated depreciation on the asset sold was 111,000. Accumulated depreciation on the asset sold was 111. So that means net book value at disposal was the cost 120 and the accumulated depreciation, which we figured out, 111. So the net book value at disposal was actually 9,000. So do you see the way you're trying to solve it? You're solving a puzzle. If you know the way statement of financial position works, if you know the way the P&L works, this is a nice question to get. And a lot of students do like the statement of cash flows. But when you're seeing these for the first time, it really takes a bit of getting used to. And if I know the net book value, and I know the profit on disposal was 24, disposal proceeds must be 9 plus 24, which is 33,000. So I must have sold it for 33,000 because I've made a profit of 24, its net book value was 9, so 30. Now you don't need to give it, but the debits and credits would have been debit bank 33, credit PP cost 120, debit accumulated depreciation 111, and then credit SOPL 24. That's what the debits and credits would be. Now, if you can think like that, it really helps you in your adjustments in the statement of cash flow question. Right, debit bank, I know that means that's going to be a cash inflow. That's going to be a positive figure in my investing activity section, like we have in the template here. Disposal of PPE, that's going to be plus 33,000. That's dealt with. I know credit PP cost, I'm going to come back to that. That's going to help explain how my PP cost went from 1960 up to 2140 because I got rid of some of that assets. This disposal, the accumulated depreciation, that has already helped me explain where I got the accumulated depreciation movement. So you're always solving a puzzle, explaining how you went from an opening balance, i.e. the balance last year, to a closing balance at the end of this year. You're using the information you have and trying to solve for the cash flow items. And finally then, credit the SOPL, that's your profit on disposal. And we know from our template for the indirect method that needs to be adjusted. That's a non-cash item. The cash item is the disposal proceeds themselves, 33. So that tells us how to calculate the disposal proceeds, working back to figure out how much we got. But we also need to figure out, well, what about the acquisition of PP? Can we explain how we got from 1960 up to 2140 in PPE cost? So you're always explaining opening and closing balances. So PPE cost here. Now I'll just delete these because we're working the opposite. You have balance brought down, opening balance 1960, and you have a closing balance at the end of the year, balance carried down, which is 2140. So you have a balance brought down and a balance carried down. So what we're trying to figure out, well, how do we explain that? First thing you have to remember is you had a disposal. That was 120. That would help explain it from above. You had a disposal, you credited property, plant and equipment. If you ignored that disposal, you would end up figuring out the acquisition was too high. So that means we have 2260 on both sides. You put the bigger one both sides, 2260. So if I disposed of 120, I have 1960 opening balance minus 120 gets me to 1840. But I actually have 2140 at the end of the year. So I must have acquired new property, plant and equipment, which would have been debit PP cost, credit bank, 300,000, 300,000. And that 300,000 is an outflow. It is the acquisition of property, plant and equipment. So you'd put it there as minus 300. So in our investing activities, you would have here disposal of PPE and acquisition of PPE plus 33,000 minus 300,000. That's the way it would look. And you'd show your workings in terms of where they're coming from. So you'd say they're working 2 and you'd say they're working 1. To show the examiner, I have calculated where they're coming from. So there is a bit of getting used to exactly where these are coming from in questions, to making sure that you're happy of how to approach them and what way to lay it out. Right? And it's completely new compared to what you're used to in IAS 1 questions. So make sure you do go back and understand exactly how that is helping you and what way it's laid out. Right? If you understand that statement of cash flow is about solving a puzzle, it really does help, because you're looking at solving how did this opening balance in cost and accumulated depreciation get to the closing balance, and you use the information that's given. And no two statement of cash flow questions will be identical. So you can't just rote learn and say, oh, this is the way I always do it. You'll see in the next example we're going to do in a second, it's laid out slightly differently. And we have to be able to adapt to understand how to approach it. So again, example 2, we're looking for the same requirement. We're looking at, well, let's figure out the relevant figures to include investing activities in relation to the purchase and disposal of property, plant and equipment. But it's given slightly differently now, whereas we're now given a single line item for property, plant and equipment. In example 1, it was split between cost and accumulated depreciation. In example 2 now, it's net book value. So cost and accumulated depreciation are in together. And we're also given a revaluation surplus that has gone up by 70,000 in the 2019 year. So they tell us depreciation was 180, an asset with a cost of 200 and accumulated depreciation of 80 was sold at a loss of 35. So it's a different approach, but we still need two things. We need to know the disposal proceeds, and we need to know how much we acquired. We'll start with the disposal proceeds. It's actually a bit easier here. The net book value at disposal is given to us indirectly in the question. It is 200,000 minus 80,000, which is 120,000. How do we know that? Because you're told an asset cost 200 and accumulated depreciation of 80 was sold at a loss of 35. So this is just 200 minus 180, minus 80. So in the previous question, they made you work harder for it. You had to deal with an accumulated depreciation T account. Here, it's presented slightly differently with the same numbers that you have to work out. And you made a loss on disposal of 35. So that means your proceeds here would have been 35 less than 120, which are 85. And that is the figure that goes into your statement of cash flows. Disposal of property, plant and equipment, 85,000. If you want to think about it in debits and credits, it's going to be debit bank, 85, which is the one we're interested from the statement of cash flows. It's going to be credit, property, plant and equipment, net book value, 120. The reason I'm not splitting it between cost and accumulated depreciation is we only have one line item to work with here. So we're just focused on the net book value. And that means you will debit the SOPL, 35. So we know then when we're doing our operating activities, the indirect method, this is a non-cash adjustment. That is the loss on disposal. So that would have to be adjusted for. And when we're dealing with our acquisition adjustment, the disposal, the net book value, would also have to be adjusted for as well. So it's just, there's a lot of moving parts when you start dealing, particularly with property, plant and equipment, and how to approach it. And practice makes perfect in that regard. The more questions you can practice, the better you'll become. So let's go on then and let's have a look at, well, how do we figure out the purchase of property, plant and equipment? We need to reconcile this net book value figure. So we're going to take a T account again, and we're going to open up property, plant and equipment. This time it's going to be net book value. So remember, what that means is you have accumulated depreciation and cost all lumped together here. The opening balance was 2390. The closing balance 2820. So we have to ask ourselves now, what moves net book value during the period? Well, one that moves it is depreciation, because depreciation will reduce the net book value 180. Technically, it does go into accumulated depreciation account, but these are merged together. So you have to think about it on a merged basis. What else will impact the net book value will be the disposal, the 120, which we have above. This green, the one that I'll highlight in green, if you make a disposal, you have to get rid of it. So you dispose of the asset, you credit the net book value. Before, in example 1, we separated out the impact in cost and accumulated depreciation. It's presented differently here to see how students adapt to it. Same principles apply. Now, where some students go wrong here now is they'll tot up this credit side, they'll get 3120, and they'll put the 3120 here, and they'll say, well, that must mean I made an acquisition of the difference. Now, this figure is wrong, but I'm saying this is where a lot of students will go to. They will say the acquisition then must be 730. Right? What you're missing here is actually some of this increase is not due to an acquisition, it's due to a revaluation. Because you're increasing the net book value. If the revaluation surplus has gone up from 230 to 400, that means you're increasing the value of property, plant and equipment. So actually the net increase here is only 560 because you revalued property during the year. If you revalue property, plant and equipment, it will be debit the asset, net book value, because I'm looking at cost and accumulated depreciation together, and it will be credit the reval surplus. And the difference there is the 170. So watch, a revaluation is not cash flow related. It's merely restating them in the financial statements. There's no impact on cash flow. But it does impact when you're trying to figure out what's the net increase in your property, plant and equipment. So that net increase, which will be debit property, plant and equipment, credit bank, is 560. So when we're doing this layout then, again, in terms of the extract, the disposal is going to be here, which we calculated to be 85, and this will be minus 560. So the big thing here is you have to explain each item. Every item is going to impact the statement of cash flows, explaining its opening balance and the movement between closing balance. And what I wanted to show you is one of the trickier ones in all of statement of cash flows is your property, plant and equipment, because it can be presented differently. They can give you cost and accumulated depreciation split out, or they can give you it merged together in terms of net book value. And that will come with practice. Right? This is the first time you've seen a lot of this, so it'll take time to go back and to practice exactly the way you have to approach it. But the more questions you practice, the better you will become at this. Right? So I also have two very similar questions, question 2 and question 3, in the question pack. Please try and attempt them if you can, and try not to look at the solution straight away. Try and come up with an answer and see are you happy with it before you go back and look at the solution. All right? So the other thing I want you to look at is go now and look at the AF1 text, the Margaret Darcy textbook. That is here, for example, and we look at DCU Library. Right, so you go to DCU Library, and if you look for this textbook, it's a very good chapter. We look at, you can say Margaret Darcy, space for the Darcy, and financial accounting. Just make sure it comes up. I'll just take out Darcy because that might throw it. Just put in Margaret, financial accounting. Now you're not looking for the 2015 one, you look at the second edition, 2019, because that is available on ebook, which allows you to access the title even if you don't have a copy. And particularly here, chapter 20 is excellent, really tailored towards it. And we can look, for example, here if we go to companies, chapter 20. You can download the PDF if you want, or you can read online. And there's a couple of examples. Some of the examples are the ones we're using in the slides, and other ones then, particularly in the chapter, can be very helpful as well. There's your PDF available if you want to download it. Very useful. So please bear that in mind. The textbooks are available online, and there's other textbooks as well, the Connolly one, which are available in ebook format as well. So make sure you review that, and we will pick that up then in week 2, looking in the first live webinar on Monday morning again.